Walmart, the largest retailer in America, with more than 10,500 stores and over 240 million weekly customers, has just sent a chilling warning, a signal that the U.S. economy may be heading straight into dangerous territory. In its latest quarterly report, Walmart revealed troubling data that even this retail giant, known for its stability, is feeling the tremors of a deeply strained economy. And when a company that tracks the shopping habits of nearly 90% of American households starts waving red flags, you can be sure it's not just noise. It's a serious wake-up call. During the fourth quarter of 2024 earnings call, CEO Doug McMillon didn't sugarcoat the situation. He revealed that shoppers are becoming more price-sensitive than ever before. They're not just cutting back, they're switching to cheaper alternatives and focusing mainly on essentials like groceries and household basics. The message is loud and clear. People are struggling, and it's starting to show everywhere. Behind the scenes, Walmart's internal data paints an even darker picture. Spending on electronics, home goods, and clothing has dropped sharply, down 7.3%, 8.5%, and 6.2% respectively, even after adjusting for inflation. Meanwhile, essential items have barely inched upward, rising just 1.2%, as more and more shoppers switch to Walmart's budget-friendly private labels. This kind of spending shift doesn't just hint at financial pressure, it screams it. And considering that consumer spending drives nearly 70% of the U.S. economy, this trend could spell serious trouble for the road ahead. But the storm clouds don't stop there. Walmart has quietly pulled back from several of its big initiatives. It scaled down its healthcare efforts, scrapped its Walmart Plus streaming service, shut down 78 underperforming stores in just 6 months, and slashed its 2025 expansion plans by a staggering 42%. Moves like these aren't just routine adjustments. They're signs of a company preparing for a long, rocky road. On the surface, Walmart's Q4 numbers might not seem too alarming. Revenue grew 3.1%, reaching $172.2 billion. But look closer. Comparable store sales growth dropped to just 1.9%, a far cry from their usual 5 to 6%. Even more concerning, e-commerce growth, once one of Walmart's strongest engines, has cooled significantly, slipping to just 13.4%, far below its previous 25% plus growth streaks. And here's where things get really unsettling. Payment behavior is changing fast. Across Walmart stores, the use of buy now, pay later services surged by 48% in just one quarter. That means more and more shoppers are now financing even basic everyday purchases. When Americans have to borrow money just to afford groceries or household items, you know something is breaking. This shift in consumer behavior isn't just a passing trend. It's a clear warning that millions of Americans are under unprecedented financial stress. People who once paid with cash or swiped their credit cards without hesitation are now turning to installment plans just to make it through the month. And Walmart isn't the only one sounding the alarm. Target has reported a 4.3% drop in comparable store sales for Q4 2024, a sharp decline that shook investors. Even Amazon, the king of online retail, is watching its once unshakable growth slow across multiple product categories. These aren't isolated cases. Together, these retail giants serve as a powerful economic thermometer. When they all start to show signs of distress, it usually means something bigger is brewing. Consumers across the board are cutting back on wants and focusing strictly on needs. That means skipping the new gadgets, shelving the fashion splurges, and sticking to just the essentials. This wide-reaching pullback confirms a deeper, more unsettling reality. Something is seriously off in the foundation of the U.S. economy. The red flags are flying from every direction. Consumer confidence is collapsing. In March 2025, the University of Michigan's Consumer Sentiment Index sank to 57.9, the lowest reading in 2 years, down sharply from 64.7 just a month before. The Conference Board's index dropped too, slipping 7 points in February to 98.3, its third straight monthly decline. When people start losing confidence this fast, it often foreshadows a downturn that's already begun, quietly spreading through homes and wallets. And as confidence fades, debt is soaring. According to Federal Reserve data, revolving consumer credit, mostly credit cards, jumped by $19.8 billion in December 2024 alone. For the first time in history, total credit card debt in the U.S. has crossed a staggering $11.21 trillion. That's not just a big number. It's a ticking time bomb. The average American household now carries about $9,700 in credit card debt, with interest rates averaging a brutal 22.8%. People aren't borrowing for luxury anymore. They're borrowing to survive. Even retail sales are flashing warning signs. January 2025 saw a 1.2% drop, worse than economists had predicted. And here's the twist. Online sales fell too, down 1.9%. Yes, even e-commerce, once thought to be recession-proof, is starting to crack. When both physical and digital stores start seeing fewer sales, it suggests the financial strain is deep and widespread. But perhaps the most alarming part is how these trends are all hitting at once. Confidence is down, debt is up, sales are falling. It's a dangerous mix, the kind of perfect storm that economists dread, because it often leads to sharp, unexpected economic contractions. And it doesn't stop there. The housing market, another key economic pillar, is showing signs of buckling. Mortgage applications have fallen for 6 straight months, down nearly 7% compared to last year. The Mortgage Bankers Association reports that the median home price is dropping in 37 out of the 50 largest metro areas across the country. Meanwhile, the Commerce Department has confirmed that new home sales just plunged 10.5% from the month before. The signs are everywhere, and they're all pointing in the same unsettling direction. In January 2025, new home sales dropped to an adjusted annual rate of just 657,000 units, a 1.1% year-over-year decline, and the lowest level seen since November 2022. That's not just a statistic. It's a flashing red light for anyone thinking about downsizing or holding investment properties. The market is cooling fast, and it's raising some very serious questions about where the economy is headed next. But the pressure isn't just mounting in the private sector. Government agencies, institutions that typically act as a buffer during hard times, are now slashing jobs too. The Department of Commerce recently announced it will cut 4,800 positions, which amounts to about 6% of its entire workforce. Meanwhile, the Department of Transportation is eliminating another 3,200 jobs. On the surface, these cuts might seem like budget trimming, but in reality, they create a ripple effect. For every government job lost, economists estimate that 1.5 private sector jobs are indirectly impacted. Less income, less spending, more strain. What makes all of this so alarming is the timing. Historically, government jobs tend to remain stable during recessions, helping to support the economy while the private sector recovers. But now, the cuts are happening before a recession has even been officially declared. That's a sign, a loud and ominous one, that what's coming could be deeper and longer lasting than most people expect. Walmart, for its part, isn't waiting around. The company is already bracing for impact. Hiring has been frozen across all non-essential departments. They've shut down 78 underperforming stores and delayed the grand openings of 23 new supercenters that were once expected to drive growth in 2025. In January, they cut 3,500 corporate jobs, their largest reduction in more than a decade. Walmart is also pulling the plug on major projects that just a year ago were full of ambition and promise. Their plan to revolutionize healthcare? Postponed indefinitely. Walmart Plus, their answer to Amazon Prime, has had its growth targets quietly rolled back. Even their budget for remodeling existing stores has been slashed by 31%. These aren't just routine course corrections. They're the actions of a company preparing for long-term turbulence. But perhaps the clearest signal of what lies ahead came straight from CEO Doug McMillon himself. During the earnings call, he warned that Walmart is preparing for prolonged consumer strain and economic uncertainty lasting well into 2026. That's not the language of a company expecting a quick bounce back. That's the tone of a giant fortifying itself for a financial storm that could drag on for years. And the data just keeps reinforcing that outlook. In February 2025, the Conference Board's Consumer Confidence Index fell another 7 points, the sharpest monthly drop since August 2021, landing at 98.3. That marked the third straight month of decline. But what's even more disturbing? The Expectations Index, which gauges how people feel about their income, job security, and the economy over the next few months, is falling even faster. The signs are everywhere, and they're growing harder to ignore. Before we dive deeper, take a quick moment to hit that like button and subscribe to the channel if you're finding this video eye-opening. Every click helps us bring you more powerful insights and keeps us motivated to deliver content that truly matters. Thanks for your support. Now, let's keep going. If you're an investor, especially one nearing retirement or already there, the signs we're seeing right now should have your full attention. This isn't business as usual. The classic 60-40 portfolio, 60% in stocks, 40% in bonds, has long been a go-to strategy for stability and growth. But in today's volatile environment, even that traditional model is showing serious cracks. Both stocks and bonds are coming under pressure at the same time, leaving many portfolios exposed in ways investors didn't expect. This economic uncertainty is reshaping how smart investors protect their wealth. Gold, for example, has surged an impressive 23% over the last year and recently broke past the $2,700 per ounce mark, a level many thought was years away. Silver? Even better, up 29% in the same period. And it's not just precious metals. Treasury inflation-protected securities, or TIPS, are suddenly in high demand as investors flock to safer assets that still offer some yield in this high-inflation, low-growth environment. In just the past quarter, the iShares TIPS bond ETF attracted $7.2 billion in new investments. There's also a major shift happening in the stock market, and it's one we haven't seen in over a decade. Value stocks, the kind backed by real cash flow, low debt, and products people rely on every single day, are finally outperforming flashy growth stocks. The Vanguard Value ETF, for instance, is beating the Vanguard Growth ETF by 7.3% this year alone. That's a clear signal that investors are no longer chasing big tech dreams. They're looking for safety, consistency, and durability. So the big question is, what should you be doing right now to prepare for the storm that Walmart and other corporate giants are already preparing for? First, cut down your debt immediately. With interest rates remaining stubbornly high, even as the economy slows, we're entering a dangerous phase called stagflation, slow growth combined with high inflation. In that kind of environment, carrying expensive debt, especially on credit cards or variable loans, will eat away at your financial stability. Second, boost your emergency fund. The old rule of saving 3 to 6 months of expenses. That may not cut it anymore. With so much uncertainty on the horizon, it's smarter to aim for 9 to 12 months. Think of it as a financial cushion in case the job market tightens or expenses suddenly spike. And third, reassess. Now, if you own real estate, listen closely. This is not the time to sit back and hope for a rebound. If you're over-leveraged or holding properties in areas where populations are shrinking or job growth is slowing, this may be your warning shot. It might be time to consolidate your holdings while prices are still relatively stable. Because if demand continues to dry up, values could begin to slide fast. Fourth, think seriously about shifting toward more defensive investments. Sectors like utilities, consumer staples, healthcare, and select energy companies have a track record of holding strong during economic downturns. These are businesses people rely on no matter what: electricity, food, medicine, fuel. Companies in these sectors with solid balance sheets and a history of paying consistent dividends can give you a rare combination: income and stability when the rest of the market turns shaky. Fifth, and this one is often overlooked, consider alternative investments that move independently of traditional markets. Yes, gold and silver are getting all the attention, but there's more to explore. Farmland is gaining value as global food security becomes more important. Infrastructure funds are poised to benefit from government stimulus and rebuilding initiatives. Even select commodities, especially those linked to critical supply chain restructuring, may offer returns that aren't tied to Wall Street's roller coaster. But here's where things get really serious, especially if you're someone with retirement on the horizon. The financial systems that once promised security in your golden years? They're showing cracks. The entire model many Americans have been told to follow: save in your 401k, ride the markets, and live comfortably in retirement, is being tested like never before. According to Fidelity, the average 401k balance for Americans aged 55 to 64 is just $232,000. That might sound okay, until you look at what things actually cost. Thanks to inflation, that amount might only stretch a few years. Most financial experts now estimate that to maintain a modest, middle-class lifestyle throughout retirement, you'll need closer to $1.8 million. Let that sink in. That's nearly 8 times what most people have managed to save. And pension funds? They're under pressure too. The 100 largest corporate pension plans saw their funded ratio drop to 92.7% in the latest quarter, down from 96.3% just a year ago. And public pension systems, which many city and state workers rely on, are in even worse shape. The question isn't whether change is coming, it's already here. The average state pension fund in America is now only 75.6% funded, according to the Pew Charitable Trusts. That's a massive shortfall, and it's only part of the story. What makes this even more troubling is that these pension funds are still assuming annual returns of 7 to 7.2%, yet over the past decade, they've only managed to deliver around 5.2% on average. If that gap continues, and especially if the economy contracts as Walmart and other market leaders are now warning, even those lower returns might turn out to be far too optimistic. In short, the retirement safety nets many have depended on for decades are wearing thin and fast. Let's talk about Social Security. According to the latest trustees report, the Social Security Trust Fund is projected to be depleted by 2033. If Congress fails to act in time, benefits could be slashed by 23%. That's nearly a quarter of your expected income. Gone. And Medicare? Its hospital insurance fund is in even worse shape, on pace to hit insolvency as early as 2028. If you're within 10 years of retirement, these aren't distant problems. They're on your doorstep. Walmart's economic red flags, combined with deteriorating retirement systems, mean many people may need to seriously rethink their retirement plans. And fast. In fact, many already are. A recent survey by the Employee Benefit Research Institute revealed that 42% of American workers now expect to retire after age 65, a steep increase from just 16% in 1991. That's a dramatic shift in expectations, driven by uncertainty and shrinking financial cushions. But let's pause for a moment, because it's not all doom and gloom. Periods of economic contraction, while challenging, also create massive opportunities. for those who are prepared. If you have liquidity, if you've been patient and disciplined, the months ahead could be full of rare openings. For real estate investors with strong cash positions, distressed properties will soon flood the market as over-leveraged owners are forced to sell. This could be the best real estate environment since the aftermath of the 2008 crash. And for stock investors, history tells us that some of the greatest fortunes are made during downturns. Market corrections allow savvy investors to scoop up high-quality companies at major discounts. Companies with strong fundamentals, real cash flow, and long-term resilience. Even investing legend Warren Buffett has taken notice. He's increased his cash reserves to a staggering $189 billion, a record high. That's not an accident. That's preparation. And what's he preparing for? Let's talk about that next. While most people panic during downturns, those who are prepared see something different: opportunity. As the economy contracts, small business owners with strong fundamentals will suddenly find themselves with less competition. As weaker businesses close their doors, those who remain standing can take a bigger share of the market. Operational costs often drop during contractions, giving resilient entrepreneurs a rare window to expand, innovate, and dominate their niches. But here's the thing. Walmart's warning isn't just about retail or Wall Street. It's a clear message for all of us. The signs are everywhere: falling consumer confidence, growing government layoffs, a cooling housing market, and slowing retail sales. Put together, these aren't just isolated headlines. They form a perfect storm that points toward a major economic downturn. This won't be a typical recession. It could hit harder, last longer, and change the financial landscape for years. But history shows us something powerful. Economic cycles are inevitable, and it's the people who prepare, not panic, who come out on top. Every downturn creates two types of people: those who are caught off guard and suffer, and those who use the chaos to build lasting wealth. So here's the truth. The steps you take in the next 3 to 6 months could decide whether this becomes a financial crisis for you or your greatest financial breakthrough. Thank you for watching this deep dive analysis. If this content helped you, please hit the like button, subscribe to stay ahead of the curve, and share this video with someone who needs to hear it. And don't stop here. If you want to know what's coming next and how to prepare even better, watch this video right here. Stay sharp, stay prepared, and let's get through this stronger than ever.